Here we go. Okay, good morning, everyone. Can you see the screen? Business entities?
Yeah.
Yes.
Okay, we're going to get started then. Um, this is continuing to be the second part of the series. We started business development, and this is primarily for those who are starting their business, who are already operating a business and want to go to the next level. We are looking to share what are some legal structures that are available to business owners if they're looking to start or if they're looking to move to a next level or expand their business. And how should you evaluate which is the best structure for your current situation? And for those who haven't been able to get a copy yet, I wrote a book, Kingdom Economics, out there a couple of years ago, and I use it as the basis for both my personal development series and also the business development series. Because what I firmly believe is you can't be expected to be strong and effective as a business leader unless you're building yourself up as a person. So there's concepts that we do during the personal development series that I think are out there. I save them out there on YouTube or on our Loving Myself business development site so that you can look back and get some good comments and tips and points to be able to develop yourself and thus developing your business. Today, we're going to be concentrating on how do I make sense of what type of business. And this is, this slide, it gives a good example of there are almost like 20 different types of business entities that you can set up for yourself. And unfortunately, sometimes we get used to hearing a lot of the popular things and we want to kind of jump into it. I hear a lot over the years, people who want to set up the business. Okay, I want to set myself up as a corporation, or I want to do this. And that might not be the best for you at the time. You could maybe go to that, but a lot of times in the planning stage, and that's why I developed this series, is that you can take a look at what type of business you're setting up and what would be the best entity to start it in, and then grow. And as you grow, you might need to change your entity as you add people, sites, locations, and all those different things. But there are two main factors when we look at deciding business entities. The two factors that you typically want to look at when you're looking at business entities is the legal liability and the tax treatment. Those are the major parts of how you can kind of evaluate how business entities should be working for you. And we're going to take the time. Now, when I say there's several out there, almost like it could be 20 different entities out there that you can form. I specifically am going to go over just these few here because basically those 20 entities is a combination of these basic business entities. And we'll talk about them in a little bit, but I just want you to know if you can get the understanding of these basic concepts of entities, then you can see how you can mix them and use combinations of them as you grow your business, which is why I say you don't always have to start in the highest level type and most complex type entity. You can have a start in the lowest and then have combinations added as you grow. But let's go over some of the basic business entities and common entities that are out there. One of the first ones that you can start at, and this is good too, depending upon the level of business that you're operating under. And keep in mind, in the past, we talked about different business entities and why you want to start your business. But business is a generic concept. You say, I own my business. What does that mean? Well, Typically, the first thing you can kind of start off when you're looking at the evolution of your business is a hobby. Typically we have a lot of things we like to do. You know, some of us like cooking. So we cook for people, and we will sit there and go in our own kitchen, cook different things, have friends over. Then people start liking it, and then your friends might say, "Hey, can you cook? I have this event, or I'm going to have this type of meeting," and then you start doing that. So that starts out as a hobby, a passion that you like, and then you roll into getting it to a point where you say, "Hey, people start wanting to pay me for doing this particular thing." Well, that's still a hobby, because in order for you to really treat it kind of as a business, and this is the IRS definition, if you have 5 years of consecutive losses when you're starting to charge for your type of business, it can be deemed as a hobby, because the intent for when you do a business is to make money. And so that's key. So a lot of things we do, people want you to do this, help you repair this, come over, can you fix this, do this, this, and that. Well, you do that, so you get your little, you get, $20, $50, or whatever type of thing, but you're not really looking at trying to make a profit, meaning that for the effort that you put out with the materials and your time, you're expecting to make money off of that over your expenses. If that's not the case, it's a hobby. And so we want to keep that in focus about it, because my intent is to get you into a business. So what do you do when you move from hobby? Well, another terminology out there for a hobby that is commonly used is side hustle. you know, you're always talking about, okay, I work a steady job, but I'm doing stuff, I'm building my own business. I got my own side hustle. I'm doing something else differently. Well, once again, if you could be doing whatever, because business is whatever that you get, you do services or sell products in for exchange, and that exchange produces a profit. Well, side hustles are very common, but at the same time, you can't go ahead and take advantage of a lot of opportunities that the federal government, the state government, local, there might be other entities, if you're doing a nonprofit, foundations, want to support you in, if you don't formalize it as one of a formal business entity. And that is where it can hurt you. A good example is this last year with the pandemic. There was pandemic dollars for corporations that would file if they would keep their doors open and still pay people. But if you look at the guidelines under small business, you had to be a corporation, or you had to be an LLC, or you had to be a sole proprietor. You had to have filed your tax returns. You have to have employees. You have to keep them on. If you don't have that formalized, you're not going to be able to take advantage of those dollars that were coming down. It's the same thing as a small business. And that's why you're always involving. Even as my entity, and I'll talk about, I formed myself as an LLC, but before that, I was a sole proprietor up to this point. But even as an LLC, and I have business and contracts with different organizations, I recognize for me to be viable, I have to go ahead and go to the state and federal and get my small business minority business participation certification. Because if I do that, it allows for companies that are participating in those programs to be able to get a deduction for utilizing me. And so if I want to expand my business beyond what I am, I have to continue to evolve. And so you don't stop growing. And that's what I want to, convey. A lot of people have their hobbies. A lot of people have their side hustles, but we got to get it into one of these entities that I'm showing on the screen for it to become formalized, so you can start taking advantage of the opportunities out there to really expand. So let's look at the first type of entity that's most common. So you move from a hobby, side hustle, and you're going to say, okay, I want to become a legitimate, and I want to be able to expand and start formalizing it. A lot of people want to say, okay, I want to jump into a corporation because I'm a company. I want to have my own company, so I got to form a corporation. And that is very complex, and there's different forms, and we'll discuss that. But if you're really just in a hobby or a side hustle, and you want to move into some formalization, the sole proprietorship is the easiest way to do it, because you don't have to file, technically, you don't really have to file a lot of legal papers to be a sole proprietor. All that's required is that if you operate as a business and you operate it under your name, you know, if I said I'm Fred Massey, CPA, then I can operate and do tax returns under Fred Massey CPA, which I did as a sole proprietor up for many years. And so I would do my tax returns, and then when I would file my individual tax, then I would include that business income onto my personal taxes. And that legitimized my sole proprietorship. So I say that if you use your own name so that it doesn't get distinguished separately from you, then you can just, as a sole proprietor, you don't have to file a separate form. All you have to do is that when you file your 1040, your individual tax return, include the Schedule C, with your revenue and your expenses, and that will produce profits, and you get taxed on that. Well, let's look at that a little bit more closer. So at the beginning of the session, I talked that there are two main factors you should look at what type of business entity best suits you. There is the legal liability. And then there's the tax treatment. Let's understand legal liability. When you operate a business, you are liable, meaning legally responsible for things that have occurred through your operation of your business. That means if you have a vendor that you need to purchase supplies from to sell or to do the services that you need, and you don't pay them, they can sue you because it's breach of contract. If you have a product that someone used, and like Joel, for instance, you fix cars. Suppose you fix cars and fix brakes, and then someone drives down and they wreck because the brakes weren't tight properly. Then they could sue you for not fixing it right, malpractice. Okay, so that's the liability. So when you are operating your business, this is what makes the distinction. This is why you can get benefits as a formalized business versus a hobby or side hustle. When you got that side hustle, you don't look at really getting sued, from you trying to help somebody, or quote jitneying, or all those different type of things, or hey, cooking for friends and things like that. You might lose friendships. You might get people blast your name out there on Facebook or Twitter or Instagram or something. But when you become a legitimate business, you are liable for what you do and operate through that business. And that's the distinction. There's a higher level risk of responsibility. And that's why you have to look at these business entities from a legal liability perspective. The other, as I had mentioned when I started talking about the sole proprietorship, is the tax treatment. Because if you're a legitimate business, the goal is to produce profit. And if you produce profit, then you are responsible for paying taxes on that. And when you get into business in certain entities, you got federal, state, your local, you can get excess tax, capital gains tax. There's various different taxes that you can pay based upon the entity that you develop and operate in your business. So those are the two main factors you look at and say, okay, and how do I want to start out in my business, and how do I want to structure it in order to move it forward? Yeah, yes, Chanel, you can unmute. Mm-hmm.
All right, so just for clarity purposes, under a sole proprietorship or whatever, you are, you're legally working underneath your own business, but because you haven't filed any particular certain tax papers, if you are sued, there's no distinction between what they're taking away. Like, they can go for your personal and your business, like all of your income. There's no distinction between the two.
That is correct. And let's get into that. And that's, if we go back and look at sole proprietor, okay, remember the two factors we want to look at: legal liability. And Chanel, you hit on it. As a sole proprietor, you are personally liable for your business. That means there is not a separation between you as an individual and you as your business. So if you did something in operating like your business and you get sued and you say, well, I don't have any more money left in my business, they can sue you personally for your own house and all this stuff that you have personally. So that is the big risk of operating a business as a sole proprietor, is that you personally are liable for your business operations. And so there's two things on a point I want to make, then I'll go into the tax treatment. And this is why, and I should have started off, I should have had a slide that said with a waiver. This is general information, but don't take this information and then say, okay, I'm just going to start this business or corporation. I will recommend that you consult legally with an attorney and also with a tax consultant or a CPA accountant for the business setup, because these two parts are important in setting up your business so you can understand, because there's no way I can cover every scenario in here. So getting back to the legal liability, I said you're personally liable for, for your business operations. Remember, when you're setting up, for your sole proprietor, one of the things, when you file with the state, because you have to file with the state for your legal entity, and then you also have to then get a federal identification number with the federal government in order to be able to operate also. So when you look at the sole proprietorship, one of the things I had mentioned before is typically if it's in your name, you typically don't have to file any paperwork to begin your operations. However, there is a caveat. If you're operating under a name that is not associated directly with you, then typically you need to file for a fictitious name with your state where you reside, so that they then could be able to publicize that if I have a claim against your business as a sole proprietor, then I can know who I need to sue. Because when you file for a fictitious name, you have submitted to the state your personal information, your address, so that that's attached. Even if you say, like, for instance, if going back to the example before, for many years, I was Fred Massey CPA. So I did tax work and all that underneath that. Well, I didn't have to file any other paperwork as a sole proprietor. I did Schedule C, filed it with my tax return. However, if I change that to Fred Massey and Associates, I would be required to file a fictitious name. Why? Because associates could mean a whole bunch of other people. So even if I was still going to operate as sole proprietor, and I want to say associates and others or whatever, I would have to file a fictitious name, even as a sole proprietor, if it's not your specific name. So that's crucial. So I wanted to note that. Now, getting back to the liability again, remember what I said, your business operations is the same as you personally. It goes even further. For those who are married and you file joint returns, and this is a caveat. This is tax advice going forward right now. You have to file 1040 when you're an individual, and then you have to file your Schedule C as a sole proprietor. See it? 1040 Schedule C tax form. However, if you file and you're married and you file a joint return, then that means that you pass on that liability to both parties on that return. So that's why a lot of times when you have those who are married, who they will file married filing separately, so that the person who's married separately with the business can file the Schedule C with that, so that if there's any tax consequences, it will be tied just to that one partner to deal with the tax part. But you still have a liability issue with the other spouse from a legal perspective. So keep that in mind. And that's one reason that I say you know, depending upon how you're going to develop your business and all, why it might be necessary to consult an attorney that helps develop businesses, or or a CPA or tax consultant to make that determination what was best. You know, because you don't think of this now, like here, okay, you might be making $60,000 or $80,000 jointly. But what happens if it becomes 250,000, $1 million, and those tax consequences and things like that? So even though most people know that when you file a joint tax return as an individual in 1040, and you have a spouse and you file it joint, you get a better tax consequence doing that way than separately. But you got to evaluate, is it better for that tax consequences when you look at the liability you're bringing to the relationship? So that's something I want to make sure that everyone keeps in mind. And we'll, you know, when we go through, if we have time, we'll look at some of these different tax returns. I mean, just so you can see as an idea. Yes, Chanel.
All right, so with the information you just gave in regards to doing your taxes together and everything like that, are you saying that in regards to any of these entities, or are you just referring to sole proprietorship that both spouses will be responsible? Does that change
Yeah, that's just for sole proprietors right now with the 1040, because as you look at the business entities, there's different tax forms and different tax liabilities tied to the different business entities.
Okay, thank you.
Mm-hmm. Yeah. If you have any questions, definitely just go ahead and hit the raise your hand on the Zoom, and that will I can be alerted. Because I want this. This is why this is basically the only kind of thing we're going to cover today, because it's very complex. When I did a seminar like this, I could almost do it for 2.5 hours, 3 hours, and so we're trying to compress it down. So let's move on to the next. Well, so then the tax treatment, then let me just, before I move on. So remember, as a sole proprietor, you file 1040, and you put your business activity on a Schedule C, and the profit or loss the profit gets taxed at your personal income tax level. So it gets included. So whatever your income tax level, your personal income tax level rate is, that's what your net income is going to be taxed at. Now, the one good thing too, if you have multiple sole proprietorships, you know, and you file multiple Schedule Cs, you can sit there and take, for instance, if you have a loss in one business, you can take the profit of that and that loss again, combine that to reduce the overall profit. So you can combine, if there's same type of Schedule C sole proprietorships, you can sit there and net those gains and losses together. Moving on to, okay, let's go to general partnership. Now, general partnership, I'm talking about general partnership. And once again, this is something that could be a hybrid. You can have a limited liability partnership. You could have, you know, a whole bunch of different type of partnerships. So I'm just talking about the basic general partnership. And a general partnership is if you have more than one person, if you have two or more. So basically, if you want to operate like sole proprietorship, but there's two of you that want to join in, then it becomes a general partnership. The sole proprietorship is just one individual operating. A general partnership is two or more. And so when you look at the legal liability, all partners are personally liable for the business. So it's very similar to a sole proprietor. Your business is not separate from the partnership. So this is why it gets a little bit more complex, because you add more people into this partnership, they all can have a responsibility and factor in rendering liability to the business and to you personally. Why? Because as a general partnership, the partners are personally liable for the business. So it's the same thing like a sole proprietorship, but with more people. So this is why, when people say we're going to form a partnership because we're friends and all that, I go back to personal development series. You better know you and the other person, because if you fall out, just because you're friends doesn't mean that you're good business partners. And if you fall out, typically under a general partnership, the partnership dissolves and you have to start over as your business entity and file again. Because what a partnership is two or more people. Let me go back to her. So a partnership is two or more people. So this is why, and then this gets more complex. So as you get into your partnership, then you have to get a partnership agreement, which stipulates the responsibilities of the partners. So that means, okay, we agree that we're going to split the profits this way. We believe that we're going to split the losses this way. We agree that we split the assets of the partnership this way. You need to have a legal partnership agreement if you're going to form a partnership. And in absence of agreement, then it's going to be assumed 50-50 or split equally among how many partners. So if you had two partners, it's going to assume 50-50 unless you have agreement that says otherwise. Now, why would you want to have agreement otherwise? If you're bringing all the money in, but another person's bringing their clients in or something like that, or bringing in knowledge or technical skills that you don't have, you might have the partnership 60-40 or 70-30. So that all determines. So that has to be spelled out at the beginning, developed in an agreement. And if you don't have an agreement, it's going to be assumed 50-50 or equally among all partners. There's more than two. So it gets more complicated, and you can see why I say you want to consult an attorney. I mean, because there's documents you can get out there and do your own agreements, but you still got to recognize it has to be legally recognized in the state that you're filing your business with. Then the second way you want to look at this business entity of a general partnership is the tax treatment. Once again, it's very similar to a sole proprietor. Your share of the profit or loss is added to your personal income. So if you have a 10-4 you're going to file because you have a job that you got W-2, and then you have a partnership for your business that you're operating in. Suppose you make $40,000 for the year and you have two of you in there and it's split equally. That means you're going to get $20,000 of that partnership income has to be added to your personal tax return, and you have to pay taxes on that. Now, I mentioned that it's not just your income tax that you have to pay, but when you file a Schedule C and you include any income onto that, that means I'm operating a business. You have to pay a self-employment tax. And that's equal to 7.65. It's equal to 15.1%. Does anyone know what that's familiar with? That's that 15.1%. Well, this is why in order to take advantage of federal dollars and state dollars out there, you have to legally form your business, is because when you file a Schedule C and say that this is not a hobby anymore, it is a business, that's Schedule C. Not only do you have to pay your income tax, federal and state, on those profits, there's a self-employment tax, because self-employment says I'm a business now. So anything I operate, I have to pay self-employment. And just like your job pays, which you might not be aware of, you can get mad when they take out your Social Security off your check and Medicare and all that. You're like, man, they're taking out, that's 7.65%. Well, your business has to match that just to employ you at 7.65. That's where you get the 15.1. So if you make money and you're as a self-employed individual, you will have to pay 15.1 self-employment tax, which is equal to the employer and employee share of the federal Medicare and federal wage and taxes. So you don't get away from that because you're a business now. So that's something to keep in mind. It's not just the income tax you pay. You're going to pay self-employment tax at 15.1% as a sole proprietor and as a general partner on the monies you make from your business. And the forms that you utilize is the 1065, that's a partnership tax return. And the way that you know how much is your profit or loss is that you produce a K1, which is your earnings that goes to every partner. And then you take that K1 and put that information on your tax return. And that becomes like your Schedule C on your 1040. Now let's move to a little bit more complex, corporations. Now keep in mind, there's various different type of corporations. Personally held corporations, which are basically your C corps, your C corporations. They're personally held. Basically, they're private. You own them. You have 100% of the shares, or if you add people in, then they purchase amount of shares. This is what's most common under small businesses of corporations, personally held companies, C corps. They're called C corporations. Well, you can also have a S corporation. And an S corporation is basically a corporation that's treated like a partnership. So remember when I said all these entities can be hybrids? And this is a good example. Your basic corporation is a C corp, but you can have a corporation that can be treated like either a sole partnership or general partnership, and that's viewed as an S corp. That's a corporation that makes an S election to be treated. And we'll talk about that a little bit, but I don't want you to just think that this is a basic corporation. So here I'm talking about just a typical C corp, a C corporation. Well, what makes it attractive from a liability perspective? Unlike a sole proprietorship and a general partnership, corporations have no personal liability typically. The business is separate from you personally. So if I operate a business that's a corporation and that corporation product or services has harmed somebody, typically, if it's set up right, they can only sue that company, not you personally. But this is why I say involve an attorney, because you can set up a corporation, but then you can sign agreements that bring you into personal liability. That defeats the purpose of having a corporation in the first place. What are some examples? Suppose you sign a corporation and then you go and set up an agreement like a credit card in the corporation's name. Keep in mind, the corporation is separate from you. So anything you do in the corporation needs to have its own separate accounts. It has to have its own separate checking accounts. And that's good for any of these businesses you set up. You should probably have a separate checking account. But then the transactions have to be done separately in your corporation, meaning that you need to have agreements that are in the corporate name, not in your name. Why? Because a corporation is separate from you. If you operate and do agreements in your name, you're going to be personally liable. Now, if you operate, like for instance, suppose you get a loan in a corporation name, a mortgage, a loan, a credit card in a corporation name, but then you sign as secondary as personal guarantee. What you effectively have done is render your corporation useless, because even though you're going to be operating and doing that purchase in the company's name, you personally have signed on as a guarantee. It's similar to, like, for instance, you go out and you want to buy a car and you want your child to have their first car, and then you have them go in and do the paperwork, and then you sign in as co-signer. you have become personally liable for signing up for that car for your child because you have signed as a co-signer. That's the same thing you do if you go and do an agreement in your company's name and then you sign on as a co-signer individually. So if you really want to operate as a corporation, you need to truly operate it. Corporation is separate from you personally. Separate bank accounts, separate agreements, all that. If you start commingling, it's what we call in a legal, from a legal perspective, you have pierced the corporate veil. So everything you have done to make it separate so they can't go after you privately, you've undermined your own self. So that's why I say, as you know, reason why I'm putting all this out there is so that when you look at it in the next month, we're going to start talking about business plan development, and then we're going to get into doing our business plans. When you're looking at part of the plan development is what type of structure you are, so you can set up your operations for your business. Well, you need to start thinking about that now and doing some research and things like that. That if you plan on truly moving to that next level to operate your business, because you can't develop a plan if you don't know if you're going to be structured as a sole proprietor, partnership, corporation, LLC, or whatever. And there's going to be different costs involved in that. And you might have to factor in some legal costs, some accounting costs, because in order to do the legal part, you need an attorney. And then to do the tax part, you're going to need an accountant, if not a CPA or a tax professional, because there's different treatments for these different entities. And that needs to be factored in if you're going to be able to truly operate in your business. Now, there's different things you can do. You can hire, or you can do contract out, you can do different sources, but you need to be able to know which way you're going to go. And this is where people get themselves in trouble, setting up companies and then going to try to file bankruptcies. But if they have co-signed on any agreements, your company might be bankrupt, but then they can go after you personally because you've pierced the corporate veil by signing on to agreements in the name of the company. So that's why it's important to understand that. Now, with a corporation, the tax treatment, this is the one thing. So the reason why legally it can be separate from you, so that people can't go after your personal assets if you do it right, is that the profit or the loss stays within the corporation, and then it's taxed at a corporate rate. Corporate rates are different. I mean, the taxation of corporations are almost at 50% when you add the federal, state, and local. Almost 50% tax rate. So, but the profits and loss then stay and are taxed at the corporate level. However, and this is why I say you might have to consult a professional, but so I'm just going to try to share this a little bit. And if you have some questions, we can talk about it. I'll be cutting off in a few more minutes and we can talk about any other questions. But now you might say to yourself, well, I invested into my company. Now, how do I get that money back into me if the profit and loss stays within the corporations or taxed at the corporation level? Well, if you want to take money back to you out of your company as a corporation, it comes back to you as a dividend. Just like when you see SEC, big SEC public companies out there on the stock exchange, McDonald's, Google, Microsoft, what do they do when people own their shares? You get dividends. Well, it's the same concept. If you're taking money back out of the corporation you invested in and it comes back to you, it comes back as a dividend, and you have to pay tax personally on the dividends that you get out of your corporation. So you make money in your corporation, so you have to pay tax on that. Then if you want to suppose you make $40,000 from your corporation, so you're going to pay at minimum 20% tax I mean, $20,000 taxes at about 50% federal, state, and local. And I'm not even going to talk about capital gains tax and all these other type of taxes. I'm just talking about your basic tax. So you're going to be paying all these taxes. And so you make profit of 40,000, you're going to be paying $20,000 in taxes. Then you say, hey, of that $40,000, hey, I want to take $20,000 out to be able to go on vacation and spend and do what I want to do for as my reward for running my company. Well, that 20,000 then just shows up on a K-1 that comes to you, and then you file that K-1 on your 1040 tax return personally, and you pay tax on that. Again, that is why if you set up a basic corporation, you ever heard of what they say, double taxation? You will pay twice on the same money as a corporation if you set it up as a basic corporation, because you have to pay a corporate rate and then you have to pay any money you take out on a personal rate. That's the double taxation of a corporation. So you got to keep that in mind. So that's why I say when people want to jump directly to a regular corporation, you're going to be paying out a nose up front. Now, the other problem with a basic corporation is if you have a loss, that loss stays within the corporation, and you can carry that loss forward so that if you have a loss this year, but you have a profit next year, you can carry forward that loss to reduce next year's profits. That's your carry forward. And you can do that carry forward up to about 15 years of a loss. So that's one of the things you can do, but it stays within the corporation. But you can't benefit it personally. So if your company runs a loss and it's just a basic C corporation, you can't reduce your personal taxes like you can do with a general partnership or sole proprietorship. But if you set up a corporation and you take an S election, say I want to be treated like a partnership or sole proprietor, then that $40,000 of profit that you make out of your corporation doesn't get taxed at the corporate rate. It comes to you 40,000 on your tax return as a K-1, and you get taxed that 40,000 on your personal rate. That's why I typically, would recommend that if you're a new corporation and you're starting up, and you know that you have a 5-year plan, but you know that within your plan, which is why it's important to have a business plan to know how long it's going to take for you to start operating in a positive. Typically it takes 3 to 5 years. So if you're going to be running losses during that period of time and you want to have a tax advantage, you can file as a corporation and then ask for the S election so that loss can come to you personally and reduce your personal tax income. But you would have to require to do that S election within the first 3 months of you filing for your corporation. Now you can do the S election later, but if you file after the first 3 months and you file for S election, you can't take it during that year. Like if we did it for this year, like if I set up my business starting in January, I have until March 31st to do the S election. If I file the S election like now in May, I can only use it starting for next year's filing. So I lose that tax advantage of rolling that loss from this year on my company over to my personal for this year because I waited too long to file and elect that S election. And that's why I say a attorney or a good tax professional who files up for corporations would know that. So the tax return that you use as a corporation is the 1120 tax return on the federal side. Then you also have to file in Pennsylvania. There's a different tax return for corporations that you have to use. So you see, the more you go up to reduce your legal liability, and more complex you get with tax treatment and government compliance. That's why I say it's easier to start at this level as a sole proprietor and perfect it, generate your things, do different things. You don't always have to jump to a corporation. But if you have more than two that are going to go into it and you want to operate both in the business, you're going to have to do it as a partnership. Now, one other thing that they have done to make it easy for businesses is form this, what they call LLC, limited liability company. And what an LLC is just a combination of any of these three. It's any of these three. It's how you file it. But what it is, it allows you from the liability perspective to be treated like a corporation. So the business is separate from you. So if you file like an LLC, what you operate as your business, as long as you keep it separate, is separately from you as a person. So Visions 2020 LLC is my business. And that's different than Fred Massey. So when I go and operate anything, my contracts, my business, seminars, services, I do it under Visions 2020 LLC. I have separate bank accounts. I have multiple bank accounts. I have payroll under Visions LLC 2020. I have insurances under Visions 2020 LLC. So legally, I'm operating like a corporation. Now, the treatment is depending how you file it. Since I'm an individual, I'm a single entity LLC. If you had two people who were operating in their LLC, they would be filing as an LLC partnership. And or you can be treated or elect to say, I just want to be running it like a corporation. So I could have elected to be a corporation, but I didn't. I'm a single entity LLC, but I could elect a corporation. Why do you want to elect these different things? Because of the tax treatment. So depending upon what you elect is how it's going to be taxed to you. If I'm a single entity, I'm treated like a sole proprietor for tax purposes. So I file my income on a Schedule C as a single LLC and pay taxes on my personal level at my personal tax rate. If I elected a partnership LLC, then I would have filed a 1065 federal tax partnership tax return, and then I would issue K1s for the income for all the partners, and then that K1 would go in your personal 1040, and you would pay at the personal tax rate. And if you elect to be treated like a corporation, then you file the 1120 tax return, corporation tax return, and you get K1s that would show any dividends that you take out of your company, and you would pay the corporate tax rate, and then you would pay the dividend on your personal. So all these entities do is show you how you want to be treated tax-wise. So an LLC just says, I'm legally protected like a corporation, but I'm taxed based on how I file as an entity under LLC. And the last structure that's common is nonprofits. Corporation. Nonprofit is a derivative of a corporation. The only difference is that nonprofits have no tax liability, but they're tax exempt from federal taxes. And then anyone that makes a donation, now here's a difference. So they're exempt from federal income tax and state income tax, but you have to file for that exemption with the state also. So just because you file with the federal doesn't mean you're automatically, you have to also file when you do your paperwork. In Pennsylvania, it's the PA 100 that you file to get your entity and your entity set up with the state. and you have to elect as a nonprofit and explain why you're filing for a tax exemption. And that's only for income tax. If you want to be exempt from sales tax, you got to file a different form. So these, all I'm talking about is income taxes right now. But there are, like I said, many taxes: excise tax, income, sales tax, all these different taxes. But I'm talking about income tax right now. And when I say, and I specify 501c3, because there are many nonprofits, foundations, savings, credit unions, savings and loans. There's many nonprofits you can file as: human services, hospitals, schools. But if you have to do a 501c3 election in order for people to donate to you, for that, their donations is tax deductible. If you're operating a nonprofit and you don't have a 501c3, I can donate to you, but I can't take that donation off of my federal taxes. And the tax return that you use to file for a nonprofit 501c3 is a 990. Now, there's an exclusion with churches. If churches set themselves up and they're not 501c3s, because churches don't have to file, as a church, you don't have to file a tax return. But there are churches that have a subsidiary that they operate that are 501c3s. So that's why I mean, your entity could be a mixture of all of these. You could have structure. I remember when I was a director of finance at community hospital for UPMC. UPMC, when they first did their merger, had over 200 different taxable entities, business entities. They had tax exemption for most of them, but they had taxable entities too as part of the structure. So you could have various different amounts of entities in your business structure. I'm going to stop there and ask for if there's any questions. You can unmute and.
Yeah, I have a question. So I always was under the impression that with nonprofits, with the 501c3, that they were never taxed for anything. So is there the possibility that they could be taxed for something if they don't file the proper tax form?
Good question. Good question. The answer is yes. Not only if they don't file the proper tax form. In order to get a 501c3 election, you have to file a form called, it's like the 1029 form, which says, I'm submitting to the IRS, and these are in just different schedules depending upon what entity, whether it be a school, a human service organization, a hospital. You have to file different forms in order to be evaluated by the IRS, because the IRS is the only one who can make the determination they make you a 501c3. So even if you file all your paperwork and it comes back from the IRS, you're a 501c3, you still can have tax liability under your nonprofit. What do I mean? I go back to my UPMC days because that's one of the largest health systems here in Pennsylvania. It's been ruled from IRS. There's a ruling that came down from the IRS that if you operate like a hospital, for instance, and you have a bookstore, remember, or a gift shop. If you notice, when you go to most hospitals, there's a gift shop that sells flowers and cards for loved ones that you can take if they're in the hospital. Well, it's been ruled that gift shops are taxable activities for a nonprofit, especially for a hospital. So if they operate, they have to track that separately, and you still can operate as a 501c3, but then on your 990 tax return, there's a form called UBI, unrelated business income. That's where you can be a tax exempt nonprofit, but still pay taxes legally, because you're operating an entity that they have deemed doesn't support the mission of your tax exempt mission. And that's crucial. when you file your paperwork, you got to get filed. This is why, if you're going to do a nonprofit filing, you need to do a business plan anyway, because they're going to ask for some of the very information you need to have in your business plan. They're going to ask for what's your vision, your mission, what's your organizational structure, organizational chart, what's your budget, what are your legal documents, articles of incorporation, your bylaws, who's your board, all those things you need to build in a business plan anyway. And so you need to have all that information, and they're going to look at the information to determine, are the activities you're reporting that you want to have tax exemption for truly supported by a mission? If they're not, then they're going to deem those activities as taxable. Another example that's being battled right now is you have like the YMCA that has the fitness. They've been under attack by other corporations that they're tax exempt for doing the same thing that LA Fitness does or other type of gyms do. What makes them non-taxable? Now, when I was running nonprofits, the way that you could say it is that because nonprofits don't pay taxes as their 501c3, the reason why you cannot pay taxes is you say that the earnings that you make from running that nonprofit get put back into the community through services and support. So by doing that, that justifies you being tax exempt. So basically what the IRS looks at, like a YMCA, for instance, that might be operating, quote, health clubs or whatever, you as a nonprofit have to show, when you file your 990, have to show how much of services that you're doing in a charitable manner to support your tax exemption. So it's not that, so if the amount of things that you're doing, for instance, the Y for fitness centers is not a great amount of earnings coming in, but they are being put back into the operations for mission purposes to help out other organizations and people, then you can still justify the fact that we're not competing at the same level of a LA Fitness or a Planet Fitness that has to pay taxes for operating. Because when they operate as a for-profit entity, they're making money for owners. Under a nonprofit, the owners are the community, and they are represented by a board of directors. So when you have a nonprofit that's tax exempt, we all own that nonprofit. Now, how we participate is through board membership, annual meetings that have to be done once a year by most nonprofits. So those are different ways you can operate that. But that, going back again, is you can be a 501c3 nonprofit and still pay taxes legally, but based off the activity you do. Any other questions?
Yes, sir.
Mm-hmm.
I have several, but I want to ask this one for right now, because when you started talking about how hospitals can be have tax liability for, like, gift shops and stuff like that, it made me think about churches, especially larger churches, where the head pastor or leader or minister may have materials that they sell, like books and stuff like that. Is that a?
Oh, that's a good question. Once again, this is why I say you should always consult an attorney and a tax professional, because it depends. If we're running book sales and the book sales go back into the operation of the church to provide missions and everything else, then you could make a case that I'm not getting personal benefit from it. Then it could be viewed as a part of the mission of the nonprofit entity. But if you're taking money off that personally and building other different things like TV revenues and things like that, then IRS could challenge that you're taking personal benefit. So therefore, that is taxable. Now, whether you tax it still, so and it depends again, if you have your church set up as a 501c3, because you don't have to, but if you have a church that's a nonprofit, then you can have a church that's a nonprofit and 501c3. See, that's why I said about the distinction. A church doesn't have to file a 990. You can file church as a nonprofit, as a religious organization, but then you can also file for a 501c3. And if you file for a 501c3, then you got to look at 990 tax filings. And then you get into the tax consequences of that. So typically, I normally, based on different stages, would look at that and saying, if you're a church and you're doing a lot of activity that's operating as a 501c human service 501c3, I like to separate that out. So you have the church who's controlling the nonprofit still, but is separate for liability purposes and also for tax purposes. And then you can operate a lot of those things through that 501c nonprofit. But then you could also operate and set up an LLC if you need to, and then operate some of those activities through LLC and just pay the taxes through that LLC. That's why I said this can get very complicated. And the problem is that if you want your cake and eat it too, what typically happens, you get bitten sometimes because you're trying to do a whole bunch of things, and you got to see it from the IRS perspective, you got to see it from a legal perspective, and you try to mix these all together, the IRS is going to deem it taxable, period, because their job is to tax. So that's why I said, when you start doing, changing, adding different services and things, you might need to think about and revisit. That's why I said you might start out as just a church, but then you say, okay, I want to do some things and make it a little bit more and take advantage of, these private foundation grants to do different things. Well, foundations require 501c3 status. So then you might have to take your church nonprofit and make it a 501c3, or you might set up a separate 501c3, which is what I typically recommend. I'm working right now with a church out in Las Vegas to do that, and to do it separately. But I have a client who has it combined, and I have another client, they broke it out separately, the organization from the church. That's what I mean. It's in different stages based upon how you're growing and what you want. If you want to get private foundation dollars, typically they want a 501c3 entity to give those dollars to. So, so that's another reason to break out for that purposes.
Okay.
Okay.
Now, this next one is not so much a question. It's kind of, I guess it's more of an observation, and I guess there could be a question behind it. But and looking over and thinking about what you said about these different types of business entities.
Yeah. Can you turn your volume up a little bit?
Yeah. Can you hear me better now?
Yeah. Yep. Okay.
All right. As I was saying, it seems like in listening to and thinking about what you said about these 5 types of business entities, and maybe I might be missing something here, but it would seem like overall, for somebody like myself, which and thinking about my car repairs, it's I've generically at times said I have a business, but it's been a hobby, from the point of profit and loss. But if I decided to make that a business, in terms of even though it's more complex in terms of, I guess, papers and stuff, it seem like overall it would seem like the least amount of legal and personal complexity would come from me setting up a single entity LLC. Would you? That
Correct. You could go as a sole proprietor, but because of the risk of the things and all that, you might want to go LLC, single entity. Correct. But I also caution too, and it all goes back to once the formalization of treatment of liability, because the difference is the liability is what you're looking at for sole proprietor versus LLC. However, you can be a sole proprietor and then have insurance that protects you in case you get sued to bridge that liability gap. So you got to look at the cost of that versus the risk of your operation and other things. But based upon knowing you enough and knowing what you would do and the things that you do, it's just as easy for you to just form an LLC, single entity, and convert that, because then you can still file your 1040 and then file your information in your Schedule C. And then you still would be having the protection of your company as like a corporation.
Gotcha. Okay, thank you. Appreciate it.
Any other questions? Once again, I recommend to read, if you haven't, I recommended last session and this session, How to Start a Business by Greg Shields. It's an excellent, because it talks about all the different, sole proprietor LLC, all the different things, and just gives you an idea of getting you ready to be able to set up to do your business plan, because we're going to be going over business plans after next month's session is just a generic of what is all involved in the business plan, and then we'll start hitting it hard over the next couple months. So I definitely recommend this book. And also too, if you have any questions, you can always hit me up on my email, visionsllc@att.net. I'm on Twitter, Instagram, Facebook. I do upload these sessions to YouTube. I ask that you subscribe to my channel, and I also upload them to our Facebook page. That's the Loving Myself Business Development section. It's a private group, so I do upload it there so that you're able to see that also. The next session is going to be business plan development. That's June 12th, Saturday, June 12th at 10 a.m. Eastern time. Look forward to you participating, and I hope you have a good rest of the day.
Thank you.
You
Thank
also.
you.
Thank you.
You're
Thank
welcome.
you. Have a good day, everybody.
That was really good.